Hey everyone, me Kevin here. The Labor Department on Friday said that inflation shot up 0.4% on Friday. That means consumer prices went up by 0.4%, bringing inflation in at 1.7% for the year. And this is way higher than expected. And this is a little bit of an, oh crap, what does this mean moment? Like, what kind of turning point is this? Well, in this video, I'm going to break down exactly that. And I want to do it in the style of the good, the bad, and the ugly. Except I think it makes more sense to go in the order of the ugly, the bad, and the good, and then I'll share some suggestions. So that's what we'll do. And a quick mention, a lot of you have been enjoying the fact that you can go to metkevin.com/M1 or just use the link down below. And if you sign up with M1 Finance and you deposit $100 using the link down below, they'll give you $20. So you literally get $20, a 20% return on your investment for 5 minutes. You could probably listen to this video and be done signing up by the time the video is over. Okay, first, the ugly. So in order to talk about the ugly, we have to talk about the baseline bad first and then put the poopy on top of it. So the baseline bad right now is that inflation isn't really even telling us how badly people are being hurt right now because of inflation. See, inflation is a measure of sort of this basket of goods. Think about some dude going shopping every single month, once a month, and he goes, box of cereal, I'll put that in. Airline ticket, I'll put that in. Oh, hotel room, I'll put that in. Oh, bundle of apples, I'll put that in. And it's the same thing that he buys every single month. It's kind of boring. He does the same thing. Oh, used car, I'll put that in the cart too. And let's just ignore the fact that a lot of these things won't actually fit in the cart, but he goes out to the checkout line and one month it's, oh, cart cost $100 this month. And then a year later, he goes and buys the same exact stuff because it's just boring dude buying the same exact stuff, goes up to the checkout window. This year, your cart costs $101. Well, then they say, the government says, we got 1% inflation. The problem with that is we're in a pandemic right now. And in that cart, you still have this dude going through the grocery store, putting in an airline ticket and hotel rooms and, other things that we're not really using right now. And those measures, like the costs of airlines and hotels, which are going down, are actually weighing down the cost of the entire basket because all the food and the apples and the beef and all that other stuff is becoming more expensive. That used car just got a whole lot more expensive, like 4% more expensive. But all that stuff is kind of buried in the cart. And so that's like the baseline problem. The way, basically, bottom line, the way they're reading inflation right now is broken. Okay, so now what's the ugly within this? Well, if inflation with this weighted down, this sort of anchored down cart is getting worse, like it's trending up now all of a sudden more than expected, despite the fact that in August, we didn't have a second stimulus package, we didn't have an unemployment boost, we didn't have stimulus checks, we didn't have PPP money. Despite all of that, we still had inflation tick up. Not the best of signs. Because here's what happens. And of course, certainly this could be because of all the money printing that's been going on. But what happens when we have inflation? Well, higher food costs, higher daily living costs, potentially higher rent costs. And for investors, what happens when, well, inflation goes up? Well, at some point, you start seeing bye-bye cheaper interest rates. Here come higher interest rates along with inflation. There go real estate prices for the time being. There go stock prices for the time being, at least in the short term. In the short term, higher inflation would hurt stocks, it would hurt real estate, and it would hurt people, especially people buying groceries every single day or just trying to get by every single day. In the longer term, inflation can end up helping stocks and real estate, which, what a surprise, something that ends up hurting poorer people ends up being good for richer people. Just the classic messed up world that we're in, but anyway. But here's the big problem. If you now couple inflation starting to go up and then potentially interest rates going up with a potential eviction crisis and a potential foreclosure crisis all coming in around the same time, you could end up with a really bad 2021. Now, this is the ugly version. No guarantees that we're actually going to see the ugly version, and certainly that would be very bad for a lot of people. But let's now move from the ugly version and talk about the bad. Well, here's the bad. The bad is that all of what I just mentioned might still happen, but one part of it might get delayed. So remember how I said high inflation means higher daily costs and general pain as prices for rent and food and cars and gas and stuff like that go up? Well, to this, the Federal Reserve usually responds and raises interest rates to prevent these prices from going up, and that helps people because it's like, oh, okay, whew, prices of things aren't going up as much anymore. It keeps prices more stable. But higher interest rates make it more expensive to borrow money and invest and buy real estate and buy stocks. Well, here's something crazy that's happening. To fight long-term potential inflation/deflation or lack of inflation, the Federal Reserve is now instituting a new monetary policy called FAIT. Yes, that is like the fate of you finally going to that link down below and signing up for life insurance in as little as 5 minutes, along with getting your $20 completely for free by depositing $100 with M1 Finance. No, so FAIT is F-A-I-T, and it is pronounced FAIT, but it stands for Flexible Average Inflation Targeting. And it means that the Fed may allow inflation to go higher for a period of months or even years. Okay, so think about what that actually means. If the Fed lets inflation go up for a period of months or years, that means food prices, rents, and the daily cost of living for people goes up. And if inflation keeps happening but rates just stay low, then that means while poor people are getting screwed with a higher cost of living, stocks and real estate are still going to be super cheap to borrow in, and you'll kind of keep inflating the bubble of stocks and real estate. So you're continuing to help rich people while screwing the poor people. Now, technically, I don't think the Fed is trying to hurt the poor and help the rich, but that just seems to be a side effect of pretty much everything they do. So basically, the Fed will allow prices to keep going up without raising rates for the time being until they average are happy with the inflation rate. But at some point, they will raise rates. So we'll have this short-term delay, a couple months, 6 months, a year, 2 years. But at some point, we'll see rates go up. Maybe that's 2023, maybe that's 2024. And in the short term, when those rates go up, we're going to see some pain in the real estate market and in the stock market. And if that pain is compounded with a sort of a delayed eviction crisis and a delayed foreclosure crisis, it could be a lot of bad when that time comes. Now, yes, inflation is still fortunately below 2%. In fact, we're at 1.7% right now, which is roughly where we've been on average since about 2013. However, we did have some more inflation in 2018, and this was back before they had FAIT. And so here's what happened, just to give you an example of this. In 2018, inflation all of a sudden clocked in at 2.4%. And the Fed, lost it. They freaked out. And guess what they did? They jacked up interest rates. And what immediately happened? Real estate crashed 12%, instantly. Remember the rule of 10x. I talk about that a lot on this channel. When interest rates go up 1%, real estate prices come down 10%. That's a lot. Well, real estate crashed 12% almost instantly in 2018. It's obviously recovered since then. And stocks also ended up crashing, although it took them about 6 months longer. So if you look towards November and December of 2018, yeah, bad times. But thanks to FAIT, we might end up having this grace period until 2023 or 2024 when the Fed actually starts raising rates. Which means, here's how I'm updating my investment thesis today. Number one, I'm going more aggressive on paying off debt than I ever have before. And most of the debt I have is investment style debt. I don't have credit card debt, but I do have, and if I had credit card debt, I'd be paying that off first. Pay credit card, consumer debt, student loans, car loans, I'd be paying that off first. Then I would be paying off my margin, especially on stocks, because if stocks end up turning volatile, you don't want to be stuck with the bag, so to speak. So that's what I'm doing. Today was a red day in the stock market, but I barely bought, mostly because I think valuations are still a little stretched. Everything right now, with the exception of Rocket Mortgage, is above my buy target. Even Peloton reported earnings yesterday, and they smashed earnings. And their stock shot up 13% in after hours, and I posted a video last night saying, nope, no. Way too high. This stock should not be over $80. It should not be close to $100. And I don't know, maybe some hedge funds around the country watched my video yesterday and the stock basically started selling off this morning, and now it's at $87, which I still think is too expensive to buy. But the point is, rather than me buying stocks on these red days right now because prices are still a little elevated, I decided to pay off more margin. So I want to constantly give you updates on these theses, if that's a word. So hopefully it doesn't sound redundant. Number two, I'm also, this inflection point does make me more bullish on real estate debt. Now, this sounds ironic because it's like, wait a minute, I was just talking about paying down debt, but now I'm more bullish on real estate debt. The difference here is with real estate, I can lock in 30-year fixed rate financing. So I just closed on a fourplex, a 4-unit apartment building, and I got an interest rate of 3.125, which is like insane for a 4-unit apartment building, like insanely low, absolutely incredible. And I've got a lot of cushion in that property. You put 25% down. If you buy it below market value, you buy it 20% below market value. Well, now you've really got like a 40 to 45% cushion in real estate equity. And keep in mind, some inflation would actually be a good thing for this strategy. See, if you have stock margin and then all of a sudden there's inflation, well, then the interest rate on your margin probably is going to go straight up. And you could get a margin call if stocks fall in value, which is bad, not good. On the other hand, if you have fixed real estate debt and your tenants are paying off your loan for you, well, inflation actually helps you pay off your loan faster because as inflation goes up, rents usually go up, and now all of a sudden your mortgage stays the same price, so you're paying off more of your mortgage every single month, or you have more cash flow depending on what you want to do with the money. So some inflation is actually good for real estate in the long run. It also helps stocks in the long run, unless of course you've got margin and you're paying higher margin rates and you got that margin call risks. So you've got this funny little balancing act that you got to play with. So that helps you sort of ride out the bumps. Obviously, we talk about that endlessly in the real estate investing course and the daily live streams that we have, when the market's open, helping you analyze your deals and your stocks. But yeah, folks, I mean, this year I'm on purchase number 11, and I'm excited to keep finding deals. So I'm okay with continuing to do that. But when it comes to cash and margin, I'm slowly trying to trickle out, because if we end up getting a big oopsies in the next 6 months, I want to have, well, A, not be exposed via margin, and B, I want to have that margin available to go shopping when prices are a bit more reasonable again. So that's kind of my strategy right now, and keep updating that. So stay tuned for more updates. But yeah, this inflation data, something to pay attention to. Let's see how September turns out. But I got my eyes on this because this was a little bit of a surprise to me. Thank you so much for watching, folks. I really appreciate it. Consider sharing this if you found this helpful. And folks, we'll see you next time.